The plan to offload Macquarie Airports, or MAP, seemed simple enough, but undocking that particular satellite fund has gone awry for mothership Macquarie after a previously unseen and aggressive intruder entered its orbit. Global Airports Group, or GAP, was rapidly constructed by some well-known infrastructure players, including former Hastings Group head and current AFL chairman Mike Fitzpatrick.
We've put up an offer which is less than a third the upfront cost of the Macquarie proposal and the MAP proposal, and we're proposing an absolutely clean break with Macquarie.
Management's really limited to talking about the procedural aspects of internalisation.
Macquarie says it's also proposing a clean break which would see MAP's existing management team left at the helm, while the investment bank collects $345 million on its way out the door. Global Airports team, which includes former Melbourne Airports chief Chris Barlow, have offered a new management lineup for a relatively more modest fee, somewhere between $20 to $100 million.
They certainly have the competence to take on the transaction, but it is opportunistic. And expecting a sale of the management rights for less than $100 million probably is a big ask, and it probably is not going to occur.
Shareholders effectively backed these entities when they floated under the arrangements that were put forward to them by Macquarie. These arrangements do deliver ongoing earnings for Macquarie, and so if they're going to forego those ongoing earnings, then they should be remunerated for them, absolutely.
For the particular circumstances for MAP, shareholders or unit holders with 50% of the vote could terminate the contract.
MAP's unit holders will be voting on the proposal, but the question is, when? A New South Wales Supreme Court hearing tomorrow is expected to consider a bid to have Wednesday's special general meeting postponed.
Full disclosure is necessary. And on a transaction like this, where the absolute intricate details of the transaction are being scrutinised, I think it's incumbent on Macquarie to disclose the details being requested before the ASX has to ask them to do so.
Tom Murphy, managing partner of Form, says to reveal more would be a first.
We have not in the past had this level of disclosure, but we have not in the past either had a global financial crisis at a time when deals of such complexity are in place. So we are in a new territory here.
The legal action will allow GAP to pursue detail on problems that could arise by removing Macquarie from control, such as possibly triggering MAP's debt agreements for Brussels and Copenhagen airports.
Certainly shareholders haven't been privy to those particular details. However, as Macquarie's intent has been to retain a large stake in MAP, we would have to make the presumption that they would only do that on the proviso that they felt there was still value in MAP.
I think the major concern is that when you look at the accounts for this particular organisation...
Independent analyst Roger Montgomery has been a long-time critic of the Macquarie model and the structure of satellites such as MAP.
The cash flow is negative. So the distributions exceed the if you like, the cash profits of the company. And indeed, if you have a look at the half-yearly reports for MAP, what you'll discover is that after financing costs and after administration expenses, the reality is that this is a break-even operation at best and a loss-making enterprise at worst on a cash basis.
For Macquarie, there's been a lot of negative perception, particularly over the last couple of years through the financial crisis, about some of these assets which have tended to have high levels of debt and have been quite volatile from a share market perspective.
Mike Younger from Citi says the Macquarie model's alive and evolving in the fallout from the financial crisis by spinning off its satellites.
And I guess a realisation from Macquarie that perhaps the unlisted environment is a better place for some of these things, given that the pension funds that are investing in the funds are doing so for the purposes of generating more fixed income type returns, rather than necessarily equity-style returns.
The issue for unit holders in these vehicles is not the asset itself. The asset is a very good quality assets. The issue is the structuring around it. You can have a great asset, but when you put lots of debt around it, it becomes a less than great investment. And that's the issue.
Macquarie's been working down a to-do list of satellites to offload. So far, MAP's been the most difficult.
We've seen them disassociate from a Singapore REIT last year, where they sold their stake to another party. Similarly, we saw them sell Macquarie Macquarie Communications Group more recently to a Canadian entity, and Macquarie Leisure, they have dissolved the management agreement and that entity has renamed.
The divestment of vehicles like MCG, now MAP, and later MIG, will actually deliver to them substantial capital.
MIG, or Macquarie Infrastructure Group, is tipped to be the next to spin off as Macquarie refines its business model.
A very large portion of earnings today does come from businesses that didn't exist 5 years ago, and I suspect if we look at Macquarie going forward in another 5 years' time, we may well be saying the same thing.
Investors may also be evolving in their willingness to pay big fees for what turns out to be a tiny slice of the millionaire's factory.